You've probably seen the headlines. News outlets buzzing, social media feeds lighting up, and conversations at work or home suddenly turning to the economy. It's not just financial experts talking, it's everyone, because these changes touch all of us. The Federal Reserve just cut its main interest rate for the first time in 9 months. This is a big deal, even if it sounds technical or far away from your daily life. The Fed's decisions shape the financial environment we all live in, and this move is making waves. It's a small move, 1/4 of a percentage point, but it signals a shift in the economic landscape. Even a tiny change in interest rates can have a ripple effect, influencing everything from the cost of borrowing to the returns you get on your savings. It's like a pebble dropped in a pond, the ripples spread out touching every shore. This decision will ripple through your financial life, from the cost of your mortgage to the returns on your savings. If you're carrying credit card debt, have a car loan, or are thinking about buying a home, you'll likely notice changes in your monthly payments. Even if you're just saving for a rainy day, the interest you earn could start to shift. Think of the Fed as the conductor of our economic orchestra, now nudging the tempo up after years of slowing things down to fight inflation. For a long time, the focus was on cooling things off, making borrowing more expensive to keep prices in check. Now the Fed is signaling it's time to encourage a bit more activity, hoping to strike the right balance between growth and stability. The Fed's new target range is 4 to 4.25%, setting the stage for banks to adjust rates on everything from loans to credit cards. This means the interest rates you see at your local bank or on your credit card statement could start to shift in the coming weeks. Lenders and financial institutions look to the Fed for cues, and they'll be recalibrating their own rates accordingly. More cuts could be on the way this year, making borrowing a bit cheaper, but also signaling that high savings rates may not last. If you've been enjoying higher returns on your savings account or CDs, now might be the time to review your options. On the flip side, if you're planning a big purchase or need a loan, you could benefit from lower rates in the near future. For borrowers, this is welcome news. For savers, it's a warning to prepare for lower returns. It's a reminder to stay proactive, review your budget, check your loan terms, and think about how changing rates could affect your financial goals. Whether you're saving for retirement, paying off debt, or just trying to make ends meet, these changes matter. The change won't be instant, but it's the start of a new chapter for your wallet. Over the next few months, you'll start to see the effects, maybe a slightly lower loan payment, or a notice from your bank about changing savings rates. It's a gradual process, but one that's worth paying attention to. Let's break down what this means for your money, so you can make smart moves in the months ahead. We'll look at how borrowing, saving, and investing could be affected, and what steps you can take to protect and grow your finances. Knowledge is power, and understanding these changes puts you in control. Stay tuned as we explore how this shift affects every corner of your financial world. From your daily spending to your long-term plans, the Fed's decision is more than just a headline. It's a signal to review, adapt, and make the most of new opportunities. Ready to take control? Let's dive in and see how you can turn these changes into advantages for your financial future. The federal funds rate is the main tool the Federal Reserve uses to keep the economy stable. But what exactly is it, and why does it matter so much to everyday people like you and me? At its core, the federal funds rate is the interest rate that banks charge each other for overnight loans. This might sound like something that only matters to bankers or Wall Street insiders, but in reality, it has a ripple effect that touches nearly every part of our financial lives. When banks lend money to each other at this rate, it influences how much it costs for them to lend money to businesses and consumers. So, when the Fed changes this rate, it's not just a technical adjustment. It's a signal that can affect the entire economy, from big corporations to small businesses and even your own household budget. When the Fed raises or lowers this rate, it sets off a domino effect, changing what you pay for mortgages, car loans, and credit cards. If you're planning to buy a home, finance a car, or carry a balance on your credit card, the federal funds rate can directly impact how much interest you'll end up paying over time. Higher rates mean more expensive borrowing, which cools spending and tames inflation. When it costs more to borrow, people and businesses tend to spend less, which can help slow down rising prices. But it can also make it harder for families to afford big purchases or for entrepreneurs to grow their businesses. On the flip side, lower rates make borrowing cheaper, encouraging spending and investment. This can help boost economic growth, making it easier for people to buy homes, start businesses, or invest in their futures. It's a delicate balance, and the Fed has to weigh the risks and benefits every time it adjusts the rate. After years of rate hikes to fight inflation, the Fed is now cutting rates to give the economy a boost. This shift is a big deal because it means the central bank is more concerned about slowing growth than runaway prices. It's a move that can affect everything from job opportunities to the cost of groceries. This move signals concern about economic slowdown, not runaway inflation. When the Fed cuts rates, it's often trying to prevent a recession or help the economy recover from tough times. But it also means that savers might earn less interest on their accounts, while borrowers could see some relief. The federal funds rate is a powerful indicator of where the economy is headed. Investors, business owners, and everyday people all watch it closely because it can offer clues about what's coming next, whether it's a period of growth, a slowdown, or something in between. Understanding it helps you anticipate changes in your own financial life. If you know what the Fed is doing and why, you can make smarter decisions about borrowing, saving, and spending. It's a way to stay one step ahead and protect your financial well-being. It's not just a number for bankers, it's a signal for all of us. Whether you're a student, a parent, a retiree, or a business owner, the federal funds rate shapes the financial landscape we all live in. So, let's take a closer look at how this important rate plays out in your day-to-day finances and why keeping an eye on it can help you make better choices for your future. The Federal Reserve, often called the Fed, has a tough job. It must balance two crucial goals, making sure as many people as possible have jobs and keeping prices stable so your money holds its value. These two goals can sometimes pull in opposite directions, making the Fed's decisions especially challenging. Over the past couple of years, Americans have felt the sting of rising prices at the grocery store, at the gas pump, and in their monthly bills. To fight this surge in inflation, the Fed raised interest rates several times, hoping to slow down spending and bring prices under control, even if that meant job growth might take a hit. Now, as inflation finally starts to cool off, there's a new concern. Unemployment is creeping up, reaching 4.3%. That means more people are struggling to find work, and job growth has noticeably slowed. The job market, once described as solid by the Fed, is showing signs of strain. The Fed has stopped calling the labor market solid, a major warning sign for the economy. Business leaders are growing cautious, and job seekers are finding it harder to land new positions. That's why the Fed is making a preemptive move by cutting interest rates now, hoping to protect jobs and prevent a bigger downturn before things get worse. It's a signal that the Fed is watching the job market closely and wants to act before a real crisis hits. This isn't about fixing a recession that's already here. It's about managing risks that are just starting to appear on the horizon. The Fed wants to keep the economy on track so families and businesses can plan for the future with more confidence. By lowering rates, the Fed hopes to encourage businesses to invest and hire, and to make it easier for people to borrow for homes, cars, or starting a business, without letting inflation spiral out of control again. It's a delicate balancing act, like walking a tightrope. One small move can make a big difference. The Fed must act carefully to steady the economy without tipping it too far in either direction. The Fed's decisions aren't just about numbers on Wall Street. They're about real people, families, and communities across the country. Keeping the economy healthy means making sure everyone, not just investors, can thrive. That's why these choices matter for your job, your paycheck, and the prices you pay every day. The Fed's actions ripple through every part of your financial life. The next few months will be crucial. We'll see if this careful step by the Fed helps steady the job market and keeps inflation in check, or if more action will be needed. As the Fed shifts its approach, it could affect your biggest financial decisions, like buying a home, planning a vacation, or making a major purchase. Lower rates might make borrowing cheaper, but uncertainty remains. So stay alert. Change is in the air, and the choices made now could shape your financial future for months or even years to come. If you're hoping for a big drop in mortgage rates, don't hold your breath. The Fed's cut won't cause an immediate plunge. Mortgage rates move more on long-term economic outlooks, and markets saw this coming. Rates have already drifted down this year, reflecting expectations of Fed cuts. This move confirms the trend, but don't expect a sudden drop. Over time, more cuts could make home loans more affordable and open up refinancing opportunities. Still, the real challenge is the shortage of homes for sale, keeping prices high. Watch the trends and be ready to act when the numbers work for you. Savers have enjoyed high yields on savings accounts and CDs, but that era is fading. As the Fed cuts rates, banks will gradually lower what they pay on savings. If you've locked in a high CD rate, you're safe for now, but new CDs will offer less. Consider locking in current rates if you won't need your cash soon. Don't abandon your savings goals, but expect lower returns ahead. Shop around for the best rates while you can. The party isn't over yet, but the music is fading. Stay proactive to make the most of your savings. Credit card and auto loan rates will dip slightly, but don't expect major relief. A quarter-point cut means your credit card APR might drop by just $1 or $2 a month. With average credit card rates still above 20%, debt remains expensive. The best move? Pay off high interest balances as fast as you can. Auto loan rates may ease a bit, but car prices and your budget matter more. Don't let a small rate cut lull you into complacency about debt. Focus on aggressive repayment strategies and shop for the best loan deals. Even with lower rates, borrowing is still costly. Stay disciplined and keep your debt in check. The Fed's rate cut is a response to a tricky economy, cooling inflation, but a weakening job market. Inflation is down from its peak, but still above target, so your dollar doesn't go as far. Cutting rates risks reigniting inflation, but the Fed is more concerned about rising unemployment. The jobless rate is up, hiring is slowing, and the Fed wants to prevent a small problem from becoming a big one. This move marks a shift. Protecting jobs is now the priority. Political pressure and internal debate made the decision even tougher. The Fed is taking a cautious, data-driven approach, ready to adjust as needed. For you, this means the economic outlook is uncertain, but the Fed is trying to steer a soft landing. Stay informed and flexible as the situation evolves. Your financial choices matter more than ever. With rates trending down, now's the time for a financial checkup. First, tackle high-interest debt. Rate cuts help a little, but debt is still costly. Make a plan to pay off credit cards aggressively. Next, review your savings. Shop around for the best rates, and consider locking in a CD if you won't need the cash soon. Don't let your money sit idle as rates fall. Homeowners, watch for refinancing opportunities as rates drop. Buyers, use this time to improve your credit and save for a down payment. A strong financial profile will help you snag the best rates when you're ready. For investments, stick to your long-term plan. Don't react to headlines. Keep contributing to retirement accounts and stay diversified. Consistency and smart habits are your best tools in any rate environment. Take action now to set yourself up for success. Finance news can feel overwhelming, but understanding it puts you in control. This rate cut isn't a reason to panic or celebrate. It's a cue to review your financial habits. Focus on what you can control: your budget, savings, and debt repayment. Use this moment to build your emergency fund and set clear goals. Stay informed, but don't obsess over every headline. Knowledge is power. Learn the basics, and you'll navigate changes with confidence. Economic cycles come and go, but strong habits last. Don't try to time the market. Build resilience instead. By making smart choices and staying engaged, you can thrive in any economy. Your financial future is in your hands. You've got this.